Hey everyone, I'm Wadi and I'm accompanied by Leslie, Yiliang, Diyu, Jinsei, and Aditya, and we're here to present you Project Rose, which is the privatization of Park Lawn Corporation. So Park Lawn Corporation is actually one of Canada's largest operating company in the North American deathcare industry. Founded in the early 20th century, they operate about 135 funeral homes and 133 cemeteries in locations across the US and Canada. Historically speaking, their financials have been absolutely stellar with very high growth rates and very high margin expansion, most of which is fueled through their net acquisitions that they make, which you can see on the right that their acquisition spending has been quite high in the recent years. In terms of the opportunity that we're presented right now, we have the opportunity to lever up 5.5 times to LTM EBITDA and purchase them at a implied multiple of 15.6 times. The purchase enterprise value comes out to about 1.5 billion, and the sponsor equity we'll need is about 913 million. All in all, we get an IRR of 26.2% in the base case, 33.3% in the bull case, and 19.2% in the bear case.
PLC operates in the North American death care industry and deals with the disposition and memorialization of remains. In short, the death care industry represents a recession-resistant and recurring revenue industry with high future visibility due to large allocations of pre-need sales. Some of the key drivers of industry are: 1, aging population within the US and Canada is favorable for pre and at-need demand. 2, increase in disposable income has a positive correlation with industry performance. 3, number of deaths is strongly correlated to at-need revenue for the industry. And lastly, increasing number of cremations pose a threat to traditional cemetery and funeral home operators. Taking a look at the top right hand of our slide, you can see that the death care industry is segmented into 2 large categories: cemetery services and funeral homes, which are then each separated into pre-need and at-need services. At the current state of the market, funeral homes contribute to 4/5 of the revenue generated in the industry, while cemetery services contribute 1/5. And although funeral homes have been a predominantly larger source of revenue, recent rising trends in cremation have decreased the size of cemetery services. From our bottom left graph, we can also see that in our forecast, this trend is expected to continue in the future due to economical reasons and the decline of cultural traditions. All in all, the death care industry is a highly fragmented industry composed mostly of small regional players. As seen from our graph, SCI is the only company in the industry to have a significant market share. Although we did not specifically separate PLC on the graph, PLC is the second largest company in the industry with a market share of approximately 1.6% as of 2021, and the company has quickly risen to its current position through making decisive runaway acquisitions to exploit inorganic growth opportunities that the fragmented industry presents. Moving on to the next slide, we conducted a Porter's 5 Forces analysis on the death care industry. We rated the threat of entrance and power of suppliers as lowest threat due to high barriers of entry into the industry and a significantly decreasing supply side coffin and casket industry. Competition, substitutes, and customers were categorized as medium threat because rising trends of cremation create cheaper alternatives from traditional burial services, which gives customers more choices and pricing options. However, none of these are considered high threats due to the extremely fragmented nature of the industry and the fact that cemetery services tend to be accompanied with stickier customers as families wish to be buried next to their loved ones, while pre-need contracts lead to high switching costs. In summary, the industry is categorized by high barriers to entry, medium competition, substitutes, and customer power, and low power suppliers, making it an attractive industry. Next, just a quick look at our projected industry revenue performance measures. You can see that as of 2021, cremations are most favored by in the industry, and our projections indicate that this will be the case until after 2022, after which all segments will normalize towards the economic growth rate, making acquisitions the most feasible strategy for sustained growth in the fragmented industry. Now I'll pass it on to Race to talk about additional industry trends.
Thank you, Jane. As illustrated on this slide, we observe strong overall population growth in North America. In the meanwhile, the deaths are also projected to increase over the same time horizon. This trend is favorable for companies in the industry as the total market size essentially grows bigger. And moving on to the next slide, for the competitive analysis, while the overall funeral and cemetery service industry is highly fragmented, there are several key players take the lead in the market share. The top 2 competitors to PLC are Service Corporation International and Carriage Services, which both of them have a slightly higher EBITDA margin than PLC. Next, I will pass on to Adi for company overview.
Thank you, Dayu. So Park Lawn Corporation, or PLC, is the largest Canadian-based operating company in North America death care industry. It focuses on industry consolidated through acquisitions and organic growth through project investments. And we decided to evaluate PLC through the VRIO framework. In terms of value, PLC offers high value as it is the largest Canadian operator and can take advantage of economies of scale and enjoys a strong sense of brand awareness and reputation. Another advantage that PLC has is that with cremation services gaining popularity, PLC already takes care of over 50% of cremation services in Toronto. Next, we found that PLC offers low rarity. Theoretically, PLC has a replicable business, and so there are many smaller companies providing similar services. However, it's important to note that high fixed costs, zoning laws, and other industry components create barriers to entry to becoming big. In terms of imitability, smaller companies may be able to imitate PLC's business model, but can't be as efficient due to PLC's size and advantage of economies of scale, as well as, again, their brand awareness and reputation. Furthermore, it's very hard for most companies in the industry to do mergers and acquisitions at PLC's rate, coupled with high fixed costs of capital and land. And lastly, PLC is highly organized. They have a very clear vision to become the premier funeral, cremation, and cemetery provider in North America with a dedicated team. The vision is backed by dynamic leadership, where the board of directors and executives have experience, knowledge, and expertise in the death care industry. Looking at the next slide, when we look at PLC's historic price performance, we find that their historical stock price has yielded a total return of 212% since 2016 to now. Historically, markets have also reacted very well to news of runaway acquisitions by the company. Now delving into the PLC's acquisitions, we found that the company spent $257 million in 2018, $65.2 million in 2019, $174.6 million in 2020, and $119.5 million in 2021 on recent acquisitions, with the target EV over EBITDA purchase multiple on acquisitions of 5 to 7 times. And now in regards to the PLC's management team, we strongly recommend continuing with the current management team, given the sheer depth of experience they have within the industry, while allowing for management equity to keep incentives aligned. As you can all see, executives have had a tremendous amount of relatable experience within the death care industry. Now looking at some of PLC's historical financials, we see that PLC has shown strong revenue and EBITDA growth alongside a good track record of margin expansion by more than doubling EBITDA over the past 5 years. The company has also been able to maintain a healthy balance sheet while going about their acquisitions. And lastly, we would like to go over some of the key investment highlights for PLC. First, they have an attractive business model with long-term positive tailwinds. Second, the addressable market continues to expand. Third, they have a large-scale platform with geographically diverse network across the United States and Canada. Fourth, they have significant white space opportunity for continued consolidation in the highly fragmented funeral and cemetery services business. Fifth, they have opportunities to expand margins through streamlining operations and improving operational efficiencies. Sixth, they have highly attractive financial performance with the execution strategy in place to achieve double-digit EBITDA and CAGR. And lastly, they have an accomplished management team with a good depth of experience and proven track record of beating financial targets. I'll now pass it on to Adi to give our investment thesis.
Thanks, Adi. So there's a lot of good things about PLC that Adi went over, and we went over the industry as well, but there's 3 that we want to focus on. So the first one being that their future acquisitions and inorganic M&A growth. Now, PLC's had a very successful record of doing M&A in the past, and they've really bore the fruit of that. We believe that partnering with a financial sponsor at this point, who's also a private equity firm and does acquisitions for a earning as well, we think that there's a lot of value to be added over there. Especially in the future, we expect that the PLC will be acquiring companies at a multiple of 6 times, starting in 2022, they're going to be spending about 100 million and eventually going to decrease to 80 million. The reason for that being is that the new CEO, Brad Green, when he joined in 2020, wanted to focus on acquisitions, but also wanted to focus on margin expansion as well. But in terms of the growth that we get from these acquisitions in the future, we can see that these are very high growth numbers, but at the same time, they're not unrealistic as well, because we've seen these growth numbers before in their historicals as well. And we think it's more likely to be continuing on that growth oriented path. Now, in terms of margin expansion, we see that right now, PLC is very kind of underperforming compared to SCI and Carrot Services, and management is doing a lot about that. So right now, they have about over 200 businesses, more than 2,000 users and 1,500 endpoints. What they're trying to do is get all of them together under a single kind of enterprise system and lower cost over there, while also creating on-site locations and cremation gardens that kind of offer you a higher margin, while getting rid of businesses like MMG that do have a low margin, that are low margin businesses. So by doing that, we can see that historical margins can increase from about 28% in 2022 expected to 34.5%. And again, these kind of numbers are not unexpected, because right now it's a 1.31 times, but before they've done 2.2 times over 5 years. Now, if you look at thesis number 3, it's basically about the organic growth and the trend of cremation. So over here, we see that right now organic growth is kind of projected to be very stable. The reason that we grow PLC over in the industry is because of their kind of personalized services that they offer, because they're doing all these remodelings of existing cemeteries, they're remodeling funeral homes, constructing new funeral homes and on-site locations. And the good thing we like about PLC in this setting is that most of their business mix is towards cemetery services. And why is that good? It's basically good because A, cemeteries have higher pricing power because land costs rise. Secondly, they're stickier customers because you want to get buried next to your loved ones. Thirdly, it's easier to build a funeral home on a cemetery than vice versa. And lastly, you just have more predictability on a pre-need basis. And cemetery services, plots of land sell more on a pre-need basis than the other. In terms of cremations, we see that there's a rising trend of cremation, and PLC is starting to enter into markets where there's low trends right now, but the expected growth is higher. We've already seen them doing very well in Toronto, performing over 50% cremations, and we see that they're also trying to cross-sell memorialization services as well. And a new platform, which is called Easy Cremation, that lets you do off-brand, really quick service. So what are the implications of all of these theses and all of this? So first of all, if we enter the transaction, we're going to be entering at a 20% premium to October 29 stock price. We're going to be purchasing it at about 1.5 billion in enterprise value, managed, and eventually sponsors are going to have to put down about 913 million in equity. And that's not going to be the only capital call. We expect some capital to be called in the future as well, just because it's a very acquisition-driven business. In terms of our key assumptions, we can see organic revenue we've kind of kept in trend with historical, and we don't see a reason for that changing. Inorganic revenue, we're going to keep the EBITDA multiple of 6 times with our annual spend, which will give us implied revenue. Cost of sales, selling in general, again, kept in line with historicals, but with the rising margins that management is targeting, we expect these to decrease in the future. CapEx and D&A are kind of kept in line with historical and stabilized because we don't really see why maintenance CapEx should be going up as a percent of revenue. In terms of the EBITDA, we expect it to hit 250 million in 2026, which is again not going to be a very surprising jump because they've done higher growths before. Now, if you look towards the sponsors perspective, we see that there's a few capital calls, but at the end of the day, at a 15.6 times exit multiple and net debt of 342 million, the sponsor gets about 3.4 billion. And we can see the deductions on the top right as well of cash, debt, and 5% management equity. From a balance sheet perspective, we can see that by the end of it, we still maintain a healthy balance sheet where the leverage ratio goes from 5.6 to 1.4, and the coverage ratio goes from 9.5 to 16.2, inclining that we have sufficient cash to pay off. Now, in terms of our outputs, we see that the IRR we're getting right now in the base case is 26.2%, 33.3 in the bull, and 19.2 in the bear case. The absolutely lowest IRR that we're getting from all of our sensitivities is 11.5, which actually does give us some comfort because it's still in the positives, whereas our other ranges are actually giving good IRRs. In terms of money and money multiple, again, 3 times in the base case, 4 times in the bull, and 2.2 times in the bear, and the lowest possible being 1.8, which is still sort of within our comfort zone as well as the absolute worst case scenario. I'll now pass it along for risk mitigations.
Thank you, Eddie. As for the risk, the first one is the internal control issue. As the business grows bigger, it becomes increasingly difficult for it to enforce internal control strategies. The PE managers can help build an internal reporting system that promotes the transparency and accuracy of accounting data. PLC can also provide training to managers of each new acquired businesses to ensure that they clearly understand PLC's reporting system. The last row shows the estimated size and manageability of each risk. We also noticed that PLC's businesses are more concentrated in certain regions where the average household income is low. Such exposure to specific areas also makes PLC more sensitive to the death rate patterns in those areas. The solution proposed is straightforward, as PLC can directly acquire the death care firms operating in high-income regions.
Other risks are related to organic growth, including the trend towards cremations. Because the average cost of a cremation is a quarter that of traditional burials or funeral arrangements, revenues may decline. PLC is positioned well to mitigate this as they're taking strides in that direction with Easy Cremation and are already a leader in cremations for Toronto. There's also foreign exchange risk, as over 80% of company revenues are generated in US dollars. As PLC doesn't currently have an active hedging program, it can manageably mitigate this risk by using currency forward contracts. Also, as Park Lawn continues with acquisitions, it can expand its operations within Canada.
High fixed costs required by death care firms is also a risk because they cannot be decreased significantly or quickly when sales did. So margins, profit, and cash flow are at risk of declining at a faster rate. This risk is inherent to the businesses operating in the industry, so the best we can do is to conduct break-even analysis and scenario analysis to find the desirable level of operating leverage that can mitigate this risk.
Another risk factor is the unpredictability of death rates and the increase in life expectancy. Mortality rate variability will have an effect on demand, and with life expectancy increasing, the timeline to demand for at-need funeral services is lengthened. Despite this, PLC is poised to address these risks because of their large size and their advantage in at-need services because of their transparency in pricing. There's also a trend amongst aging baby boomers who are embracing planning for their funerals, which brings opportunity for Park Lawn to grow revenues from pre-need services. The effect of COVID-19 also has risk implications on the demand side, since pandemic restrictions have led to smaller and simpler ceremonies, resulting in lower revenue per funeral. And on the supply side, Park Lawn may continue to face interruptions in their supply chain and disruption from having to temporarily reduce staffing in closed facilities. In spite of these obstacles, Park Lawn can leverage higher death rates to increase their pre-need sales, which should offset the low revenues per funeral call. And lost revenues or margins owed to the pandemic are expected to be recouped as disposable incomes and the boomer age population rise.
Lastly, there's uncertainty in the firm's ability to sustain a high leverage ratio, especially considering the trend in the interest rate environment. The Bank of Canada has already ended its quantitative easing program, and as the economy recovers from the pandemic, there's no promise that interest rate will remain at the current low level, so the cost to keep the desired debt level may rise. To cope with that, we can use a combination of different debts to lock in the current interest rate or to hedge against an unexpected rise. But at the end of the day, it still depends on forecasts and speculations, which are more or less arbitrary. Now let's move on to further diligence.
So in terms of further diligence items, right now, PLC is a publicly traded company, and we do have a lot of data on them, but here are some diligence items that we want to look further into. First of all, we want to look into the subsidiary performance that they acquire. We want to basically segregate the organic and inorganic growth of a subsidiary and also see what this subsidiary looks like with or without the synergies that it gets from the other business units that Park Lawn acquired. Secondly, on sourcing and execution strategy, we want to see what's management's rationale to even buying a company? What do they look for? Where do they look for it? And like, what are the decision metrics? What kind of returns do they target? We know that on their local projects, they try to target 15% IRR, but in terms of their deals, like what kind of return are you looking for? And what kind of types of analysis do you do? And how often is your analysis different from what actually happens in the future? And we also want to look at the frequency of failed bids against a competitor just to gauge how much of a good bidder you are in the competitive process. And in terms of financial details, since it is, again, publicly traded company, but mostly consolidated financials, we would like a revenue breakdown by product category, by region, pre-need by age category, and region, and cremation sales by region as well. Ideally, quality of earnings report or a 2022 budget would also be very helpful, along with the access to the acquisition pipeline to see what kind of expenditures might be coming if we do acquire this company at the end of 2021. In terms of operational items, we would like to see some key KPIs that management keeps track of, some customer complaints and frequency, any appraisal of properties. We would like to see what kind of organic projects they have in the pipeline, a supplier breakdown, any market expansion plans, and any breakdown of the acquisition integration cost, because that is part of the strategy. In terms of organization and legal, pretty standard items, for example, minutes of incorporation, board minutes, board presentations, customer, all kinds of different contracts and agreements, environmental reports, lease agreements, and any ROFR as well if possible. On the HR side of things, we would like to see how employees are doing in the company, the employee turnover, any termination causes, any pending litigation against terminations, and just a satisfaction survey and some detailed payroll to see where cost cutting would be possible as well. Now, all in all, Project Rose represents a unique opportunity to acquire a leading operator in the North American death care industry at an applied IRR of 26.2% in the base case and money-on-money multiple of 3%. We generally believe this is a very good growth-oriented company, and they're going to be doing very well. And we think that right now is a good time to buy them than later when they've realized that growth. So all in all, based on our presented analysis, we recommend moving to the next stage of the process with Project Rose. Thank you so much for listening to us, and we're open to any questions.